Hey everyone, welcome back to Corporate Decoder, the place where we break down the jargon and find the juicy details behind all those big company reports. Today we're diving into Establishment Labs Holdings Inc.'s latest quarterly report, and let me tell you, it's got a few things worth unpacking, especially when it comes to their finances and future plans. Alright, before we get into the nitty gritty, if you're all about getting the real story behind company filings without the boring stuff, make sure you hit that subscribe button. And hey, we've got a great community growing on Discord, linked in the description below, where we talk all things corporate finance. Join us! Alright, let's get into it. Establishment Labs, known for their Motiva implants, which are a big deal in the plastic surgery world, just dropped their financial results for the quarter ending June 30, 2025. Think of this as a mid-year checkup for the company, showing us how they're doing and what they're up to. First up, let's look at their balance sheet. This is like a snapshot of what the company owns and owes. As of June 30, 2025, their total assets were around $330 million. Now, compare that to the end of 2024, where they had about $340.25. That's a big chunk of cash gone, nearly 40% less. On the flip side, their liabilities have grown. Their accounts payable went up from about $45 million to over $55 million. This means they owe more money to their suppliers. Overall liabilities are up to around $307 million compared to $294 million at the end of last year. And for the owners, their shareholders' equity, which is essentially what's left after you subtract liabilities from assets, has taken a hit. It's down from about $53 million to just $23 million. This decrease is largely due to the company's net loss. Now let's talk about how they made money, or in this case lost it. Looking at their income statement for the 6 months ending June 30, 2025, their revenue was about $92.7 billion. That's a good increase, about 14% from the $81.3 million they brought in during the same period in the previous year. So sales are definitely heading in the right direction. But here's the catch. While sales went up, their expenses also went way up. Their sales, general and administrative expenses, or SG&A, shot up by a massive 36% from $61.7 million to $83.9 million. That's a huge increase in just 1 year. They also spent more on research and development, going from $9.8 million to $10 on research and development. Going from $9.8 million to 10 more on research and development. Going from $9 to $8 million to $10 them going from $9.8 million to $10 fed at $3 million. All these rising costs mean their operating loss for the first 6 months of 2025 widened to $31 million compared to about $18 million in the same period of 2024. They're selling more, but they're also spending a lot more to do it. When you factor in everything else, like interest and taxes, their net loss for the first 6 months of 2025 was $37.25, was $37.33.24. So even though revenue is climbing, they're still not making a profit and their losses are actually growing. This means that even as they expand, they're not yet doing it profitably. Looking at just the 3-month period ending June 30, 2025, revenue climbed by over 16% to $51.3 million. This growth seems to be powered by their successful entry into the United States market after getting FDA approval for their Motiva implants in September of the previous year. They're seeing strong sales there, which is a huge positive. Their gross margin, which is the profit they make after accounting for the direct costs of making their products, also improved. It went up from 65.6% to 68.8% for the quarter. This is likely because they're getting higher prices for their implants in the US market. That's a good sign that their premium products are finding a good reception. However, R&D spending dipped slightly for the quarter. They spent about $5.2 million compared to $5.55 million in the same quarter last year. This might seem like good cost control, but it's worth noting that they have a big decade-long post-approval study for their Motiva implants in the US that they estimate will cost between $4 million implants in the US that they estimate will cost between $4 million and $5 million over the next 10 years. So while R&D spending might fluctuate quarter to quarter, the long-term investment is still there. A big swing we see is in their other income expense net. In the 3-month period ending June 2025, they reported a gain of about $4.4 million, a big jump from a loss of $2.8 million in the same period. In 2024, this swing is mostly due to foreign currency movements, particularly with the euro and Brazilian real. It's good to see a gain here, but it's important to remember it's heavily influenced by currency exchange rates, which can be unpredictable. Moving on to cash flows, the operating activities used about $39.5 million in cash in the first half of 2025. This mainly comes from their net loss and changes in how they manage their assets and liabilities, like inventory and accounts receivable. While they saw a gain from foreign currency exchanges, the overall story is that their core business operations are still consuming cash. Their investing activities also used cash, about $3.4 million. This was mainly for buying property and equipment and some costs related to developing a new computer system for the US operations. They also had some money tied up in business acquisitions. On the financing side, they brought in about $49 million. This came from some short-term borrowing and money from people exercising stock options. It's a pretty small amount compared to the cash being spent. Remember, they had a big hit to their cash balance we saw earlier. All of this adds up to a significant decrease in their cash balance. For the first 6 months of 2025, their cash went down by about $35.7 million. This aligns with the drop in their cash reserves we observed on the balance sheet. It shows they are actively spending money to grow and operate. Now, let's talk about debt. Establishment Labs has a significant amount of debt, about $221 million outstanding under their credit agreement with Oaktree. This debt matures in 2027 and accrues interest at various rates, generally around 9% to 10% per year. They have made some amendments to this agreement, which is common as companies grow and their needs change. Looking at their share-based compensation, it seems a lot of their employees and executives are compensated with stock options and restricted stock units, or RSUs. For the first 6 months of 2025, they recorded about $5.6 million in stock compensation expenses. This is how they incentivize and retain talent. They also have about $1.2 million in goodwill on their books, which usually comes from past acquisitions where they paid more than the fair value of the acquired company's identifiable assets. It's not a huge amount, which suggests they haven't made massive acquisitions recently. Now, the company spends a lot of time talking about risks, and there are many. One of the big ones is their limited operating history in the United States. While they've got FDA approval now, they're still the new kid on the block in a big market. They could face challenges that other early-stage companies encounter in competitive markets. A major risk they clearly state is that they expect to keep losing money for a while. Their ability to become profitable really hinges on how well their Motiva implants sell. As of June 2025, they had an accumulated deficit of about $482 million deficit of about $482 million. They also warn about global economic and political issues. Things like slow growth, recessions, or trade wars can hit their business hard because people tend to cut back on elective procedures like cosmetic surgery when money is tight. That's a constant concern for companies in their industry. Another critical risk is their reliance on Aventor as their only supplier for the medical grade silicone used in their implants. If Aventor has supply issues or decides to raise prices, it could really hurt Establishment Labs. They've had to deal with this in the past, and it's a significant vulnerability. Finally, they flagged that their stock price can be all over the place. The market for medical device companies can be really jumpy, and many factors from economic conditions to competitor actions can cause huge swings in their stock value. So what's the big picture here? Establishment Labs is growing its revenue, especially with its big push into the US market. That's a huge positive. And the improved gross margins show they can command good prices. However, their expenses are rising much faster than their revenue, leading to wider losses. They are burning through cash, and while they have some debt, it's the growing expenses and continued losses that are the main concern from a cash perspective. Their reliance on a single silicone supplier is also a big red flag. They're in an exciting growth phase, but they've got a long way to go to prove they can be profitable. It will be crucial to watch their expense growth and see if they can really capitalize on the US market to turn those losses around. Supplier is also a big red flag. They're in an exciting growth phase, but they've got a long way to go to prove they can be profitable. It will be crucial to watch their expense growth and see if they can really capitalize on the US market to turn those losses around. The main concern from a cash perspective. Their reliance on a single silicone supplier is also a big red flag. Alright, that's our deep dive into Establishment Labs' latest report. What do you think about their growth strategy and those rising expenses? Let me know in the comments below if you found this breakdown helpful. Give this video a thumbs up, and don't forget to subscribe for more corporate insights. And once again, come join our Discord community. The link is in the description. It's a great place to connect and discuss these kinds of reports. Thanks for watching, and I'll see you in the next one.